to the latest unemployment figures. They've just come out. What do they say?
Yes, so the unemployment rate has actually fallen to 3.6% in May. So that's 1/10 of a percentage point from April. So 3.7% in April to 3.6% in May, seasonally adjusted. And employment actually increased. So the Bureau of Statistics saying the employment increased by 76,000 people. The number of unemployed people decreased by 17,000 people. So therefore you saw the unemployment rate fall. Now, this strong growth in employment in May followed a small decrease in April around Easter, when employment fell by more than it usually would over the holiday period. Also, the Bureau of Statistics saying the increase in employment in May saw the number of people employed in Australia reach 14 million for the first time. So economists had actually expected the unemployment rate to stay steady. It's 3.7% and about 17,000 jobs created. So this figure suggests that the employment market is still very strong, even though we are seeing a decline in job ads. It also shows that demand for labour remains, and certainly does it across a lot of the economy, such as medical, such as education and retail, despite a fall in consumer confidence and also a fall in business confidence as well. So St George Chief Economist Besa Deda joins me now. Thanks for joining us, Besa. So what's your reaction to these employment numbers? What did you expect?
We were looking for a rise of 40,000 in the month, which was at the high range of economists' estimates. But the result was still very much stronger than what we anticipated, and we have seen that dip in the unemployment rate. So I guess the key message is that the labour market continues to remain incredibly tight. Since October, we've seen it keep in a range of 3.4 to 3.7%, which is below the rate consistent with full employment in the economy, and therefore there is that risk still of wage pressures building. Now, we do think that the unemployment rate will gradually move higher, but the unemployment rate has, I guess, in recent months continued to surprise in terms of reflecting the strength of the labour market.
Well, it certainly shows, doesn't it, that the employment market's still strong, doesn't seem to be showing much sign of slowing down at the moment, and the unemployment rate's still near 50-year lows.
Yeah, absolutely. The 3.6% unemployment rate that it's come in is incredibly low. I guess if we look at forward-looking indicators of employment, they can give us a bit of a guide as to what we can anticipate for the unemployment rate. And when we look at job advertisements and job vacancies, they have begun to fall in recent months, and we look at the number of applicants applying for a particular job, that's also risen. So these are signs that the labour market is set to loosen. But we have to keep in mind that job ads and job vacancies are still at an incredibly high level, and that's why the rise in the unemployment rate might still be very gradual and still to materialise. It does keep the pressure on the Reserve Bank to raise rates again, given that the labour market wage pressures do feed into the overall inflation story.
And just having a look at some of the breakdowns there, we see full-time employment increased by around 33,000, part-time employment increased by 6,700. So good news, there's still full-time jobs. So where do you see the unemployment rate going then? Reserve Bank predicting it could rise above 4%.
We would agree with that. Our forecasts have the unemployment rate heading to a little over 4% by the end of this year, and then having a 5 in front by the end of next year. The Reserve Bank is raising rates to bring down inflation, and that is showing that demand is weakening, and that softer demand will flow through to a softening in hiring activity as we move through this year and next year. And then there's also a very strong ramp up in net overseas migration, which is helping population growth, and that's providing an injection of labour supply into the Australian economy. So both of those factors will help soften employment growth as we move through this year and next year, but it does appear that it is going to be a gradual process initially in terms of that unemployment rate ticking higher.
Now, given there was a big jump in the number of jobs created, as we mentioned, 75,900. So is there any indication that higher interest rates are having an impact on the employment market?
Well, I think we can see from the forward-looking indicators of employment that there is some impact coming through because job advertisements and job vacancies are trending lower, but still very elevated. So I think there are some signs that high interest rates are likely to produce a softening in employment growth. But we have to keep in mind that employment is a lagging economic indicator of economic activity. And then we also need to keep in mind that businesses have gone through a period during the pandemic where it's been incredibly hard to source labour. And so even when economic demand is softening, it may take a bit longer than usual for businesses to soften their hiring activity because they've just been through this period where labour has been very difficult to source. So twice, if you're bitten twice, you might be shy.
What about where interest rates are going? Some economists see interest rates going to 4.85%. Where do you see rates going?
Look, we think the Reserve Bank does have more work to do on the interest rate front in terms of bringing down inflation. So we do anticipate a further rate hike from the Reserve Bank, and we wouldn't rule out further tightening in terms of a second rate hike after that. Our group view is that there'll be one rate hike in July, which will take the cash rate to 4.35%, but we wouldn't rule out further tightening after that, given that inflation is still very elevated and also given today's data that the labour market is still incredibly tight.
We're also seeing increasing predictions of a recession in Australia. What's your forecast?
Well, certainly the higher the cash rate goes and the longer the cash rate stays elevated, that is, the longer it takes rate cuts to materialise or the next cycle to materialise in terms of monetary policy, there is that rising risk of a recession. The RBA and other central bank heads still have a lot of work to do in bringing inflation down. We saw the US central bank overnight pause after 10 consecutive rate rises, but the head of the US Federal Reserve still flagged that more tightening was likely in terms of bringing inflation down. And so there is still more work to do. And whilst there's still more work to do, there are those rising risks around a downturn forming.
And in terms, you just mentioned the US there, so rates currently at 5% to 5.25%. The Federal Reserve Chairman Jerome Powell suggested more rate rises ahead, as you said. So could we see a rate of nearly 6% in the US?
Well, one of the things about the Federal Reserve meeting last night, or very early morning Sydney time, was that the statement was accompanied by a dot plot. So the members of the Federal Reserve Board put forward their predictions for the federal funds rate. And the median was for 2 more one-quarter rate hikes from the Federal Reserve before the end of this year. But you get a range of forecasts, and the range, the top of the range was above 6%. So you wouldn't fully rule it out, but the median is for 2 more rate hikes. Similar to here, the monetary policy takes time to fully flow through to the economy, and the Federal Reserve Chair certainly acknowledged that in his press conference and also in the statement that, they had tightened policy very aggressively in a short space of time. And now they, taking time to consider the impact of those significant rate rises, and also acknowledging that the lags or the flow through of monetary policy is quite variable and uncertain.